and welcome to the latest Insider interview. I'm here with Helen Steers, manager of the Pantheon International Investment Trust, ticker PIN on the London Stock Exchange. Helen, thanks for coming into the studio.
Delighted to be here, thank you.
The trust dates back to 1987 and it is the oldest listed private equity trust on the London market. Can you explain what that really means?
So very simply, what PIP or Pantheon International does is it makes the private public. So PIP is a £1.7 billion FTSE 250 investment trust. It's been around for 35 years, as you say, and it gives investors easy, liquid assets to all the growth opportunities that you have in private markets. But it does it in a very easy, accessible format because the shares are quoted on the London Stock Exchange.
And how are you investing in private companies? Are you buying shares directly? What's your process?
So PIP is actually a hybrid vehicle. About 45% of the trust is invested directly in companies, and about 55% of the trust is invested in top private equity, venture capital, buyout, private equity funds. And these funds are often very difficult to access. They're invitation only. So we effectively give investors access to those hard to access funds, plus these direct investments for almost 50% of the trust.
And you've described it as the missing link for a retail investor's portfolio. What do you really mean by that?
So it all goes back to this phenomenon of shrinking public markets, which has been written about quite a lot. So over the last 20 years, public markets have shrunk by about 50%. What that means is that the companies that are left on public markets tend to be larger, older, slower growing. In fact, all the exciting growth and value creation is happening in private companies. Companies are staying private for longer, sometimes they never IPO at all, in fact. And therefore, if an investor wants to get access to these private companies, it needs to invest in private equity. But private equity in its traditional format with private equity funds is very difficult for individual investors to get into. Therefore, PIP, which essentially makes the private public, is a very easy way for investors to get access to this whole world of fast-growing private companies.
What types of companies do you own? Are you looking at fast-growing companies or cheap companies? What's inside the portfolio?
So we're looking for fast-growing companies in very resilient sectors. So the sectors we really like are information technology, healthcare, consumer staples, consumer services. We tend to invest, though, in buyout companies, small and mid-market buyouts, and growth capital. Only about 4% of the trust is actually in venture capital. But even though they're in buyouts and growth equity, they're still in sectors which are benefiting from these incredible tailwinds created by digitalization, for example, or aging demographics.
And what are the similarities and differences between private and public markets? If we see, prices collapse in the public market, what's happening in the private space? Is the portfolio a way of actually dampening some volatility in a whole portfolio?
That's a really interesting question, actually. So both private and public markets are equities, so there is an equity risk in both. But in private equity, you're holding on to the companies for a lot longer, and there's a lot of value creation that occurs over 5 or 6 years. Generally, the private equity managers have control or significant influence over these portfolio companies, and they can pull all sorts of levers to create value. They can also choose the time at which they exit from their portfolio companies. And they're not dependent on public markets to exit the companies. In fact, our biggest exit route is actually trade sales. So strategic buyers coming in and buying a company because it fits their sort of portfolio. Second biggest exit route is actually secondary sales to other private equity funds. And IPOs actually only account for about 10% of our exits. So we're not dependent on strong IPO markets to get that sort of valuation bump. Now, to your valuation question, sort of interestingly, private equity managers like to always surprise on the upside when they exit from a portfolio company. So you'll find that they tend to dampen valuations. So they don't write the companies up so much when public markets are rising, and they don't write them down quite as much either, sort of in reaction to a big fall in the markets. And that's quite fair, actually, because what they're doing is they're looking at value creation over a much longer period of time, as I've mentioned.
And you said pulling levers there. So how do you extract value from your investments? And is there a typical case study or a typical thing that you do that actually improves the performance of the companies that you own?
Well, it is all about operational improvement. Private equity tends to have this image of it's all about leverage, but actually, if you look at the way that value is created in our portfolio companies, it's all about these operational improvements, so increasing revenues and increasing the profits of the businesses. Now, the managers can do that in various ways, inorganic and organic growth. Inorganic growth, that's really about mergers and acquisitions, so buying companies they can bolt on to the original company, make it a bigger group and benefit from synergies, but also organic growth, so they can expand the company's product lines, they expand the companies geographically, they can develop new areas for the businesses. And then really importantly, private equity managers have a lot of people on staff that they can bring into the companies to help. So frequently, in terms of centralised resources, they'll help people with talent management, so helping to recruit good people, with supply chain management, obviously particularly important during COVID, to help with your supply chain, to procurement. Digitalisation, again, really important during COVID, where a lot of companies had to go from offline to online pretty rapidly.
And the portfolio owns about 600 companies. That's a lot. Some public market funds might own hundreds, and that would be maybe a bit too much. Some own 25, 30. So are you a very risk-averse investor, or is this just how you go about private equity?
Well, we like to think of PIP as an all-weather portfolio. It's been around for 35 years. It's weathered all sorts of different macroeconomic cycles. We've been through COVID, GFC, dot-com boom and bust. We've been through the Asian crisis. So it's been through a lot of different cycles. And I think what's helped the trust is being very well diversified and being in top quality types of investments. In terms of diversification, this is a global trust, and we do invest globally. Over 50% of the portfolio is actually in the US, which is the deepest, most sophisticated market for private equity. So in terms of diversification, we're diversified by geography, we're diversified by sector and subsector, we're diversified by vintage, and that means we've got investments that have been made at different times, and we're diversified by different types of private equity manager.
And how has performance been in these really tough times for markets? So COVID, financial crisis of 2007. Did this diversification work? And did the stock plummet with the rest of the market, or did you kind of hold your value a bit better?
Well, over long periods of time, we have outperformed public markets by a considerable margin, so between 300 and 400 basis points, depending on whether you're looking at the FTSE or the MSCI World. During difficult periods, yes, the stock has gone down like other stocks, but we've had good recoveries afterwards. And if you look at the recent performance, we've actually done extremely well through COVID. I think part of that is due to the choice of sectors. So we've had some really resilient sectors. I mentioned information technology and healthcare, but also consumer staples and services have held up really pretty well. And we had very little exposure to physical retail or to leisure, travel and hospitality. So that really helped us actually.
And the trust is on a 23% discount at the moment. That's a lot. Is that a bargain for investors, or is that normal? Why is it there, and are you trying to narrow that discount?
Well, it's not warranted. We find it extremely frustrating because we can see the value that there is in the trust. We have delivered to investors over 35 years over 12% net returns. And as I said, that's 300 to 400 basis points over the public markets. In terms of value, when we exit a portfolio company, we look at the last valuation that the company was held at in the portfolio. And in the last 6-month period, when we reported to 30th of November, we were showing an uplift on exit of 43%. So that's a measure of the embedded value in the portfolio. And in fact, if we look over longer periods of time, we've had between 20 and 30% uplifts on exit. So in fact, the portfolio, we would say is undervalued because of this proof of the uplifts in valuation. So we do think that the discount is unwarranted. We think there's a certain amount of sort of a perception problem really about private equity. People don't know enough about it. So in fact, interviews like this are really, really good because it shines a bit more of a light on private equity. And the discount is actually a sector-wide issue. If you look at other private equity investment trusts, there is this discount. So we're doing everything we can. You asked what we're doing. We're trying to talk more about the trust, talk more about the companies in the trust, so that people understand a little bit more about private equity and how it can fit into their portfolios.
And is 23% normal, or is that a bit more than average? Basically, is now a good time to buy it, or are you a bit more expensive than normal or cheaper than normal?
We would never make recommendations to buy, and I would always say that really for any stock, you've got to think about the long term. And I suppose again, I would point to our long-term performance and say that we think it's a good stock to own for the long term.
Helen, thanks very much for coming in.
Thank you, Sam, and thanks for your great questions.
And that's all we have time for today. You can check out more insider interviews on the YouTube channel. Don't forget to comment and subscribe. See you next time.